Welcome to Chapter 3 of the Call Options course. In Chapter 2, we looked at 3 Apple options from a buyer's perspective. In this chapter, we're going to look at it from the seller's perspective. So if you recall our land options, the first option was at the money at $1 million. And if the price of the land went up above $1,025,000, which was the premium, then the seller was exposed to unlimited losses on the upside. On the downside, even if the land went to $800,000, his profit was capped at $25,000. And if the land value stayed put at $1 million, the seller was profiting by $25,000, which was his maximum profit in that option. Similarly, the $1.1 million, the seller was exposed to unlimited losses above 1.1 plus the premium, which was 10,000. So that's the opposite of the buyer. So the seller is going to have a profile that is exactly opposite that of the buyer. So that's the opposite of a call buyer. The seller has unlimited losses on the upside and limited profits on the downside. So let's again look at our same options, which is the June series, having 54 days to expiry. And we look at our same 3 options, the 570 call, which is equivalent to the $1 million at the money option, the 625 call, which is equivalent to the $1.1 million option, and the 520 call, which is equivalent to the $800,000 option. Let's look at our first option, which is the at the money. And I'm going to put that into my order screen and change it to 1 contract. So for 1 contract, if I'm a seller of this option, I will receive a premium of $38.35. So for 100 shares, which is what 1 contract represents, I'll receive a total premium of $3,835. And this is going to be my maximum profit on this particular position. So let's see how that plays out on the P&L diagram. So we come to our risk profile and we click the risk profile, and you'll see that it's exactly opposite that of the call buyer. So what do we mean? If we just change this from a sell to a buy, we'll see that the call buyer has unlimited profits on the upside and limited losses on the downside. And the profile of a seller is going to be exactly the opposite, because there are only 2 parties to this contract. It's the buyer and the seller. So all profits, all losses have to be shared in some manner between the buyer and the seller. So if I change this to a sell back again, you'll see that the seller has a limited profit. If the price of Apple stays either at 570 or it goes down, his profit is capped at this amount, $3,835. You'll see that over here. So that's his maximum profit on the day of expiry. And if Apple starts to go up and beyond the break-even price, which was 609 almost, then the seller is going to be exposed to unlimited losses here on the upside. So if Apple goes to 680, 690, or even higher, the seller is going to have unlimited losses. So the seller has unlimited losses on one side, and seller of options always will have unlimited losses on one side. So the important thing you have to understand here is that if you look at this margin calculation, so here we have a buying power effect of 11,000. So because a seller of an option has unlimited losses, your broker is going to hold back a lot more margin than if you were to be a buyer of the same option. If you recall, in Chapter 2, we saw that the broker held about $3,880 as margin as a buyer, because that was the maximum loss for the buyer. However, for a seller, the maximum loss is somewhat unrestricted. So then they're going to hold a much larger margin if you're a seller of the option. And that brings me to these 3 lines here also. These are, this whole area we can simulate the trade. So what the plus 10% and minus 10% is telling you is that what would your position look like if Apple went up by 10%, and what would your position look like if Apple went down by 10%. If it went up by 10%, which means it's going to go from here to about 630. So this is your 10% line. So this dotted line is your 10% plus 10% line. This dotted line is your minus 10% line. So if Apple went up by 10%, then you would obviously incur a loss, because that's exactly what the white line is telling you, is your loss will be at that point will be about 3,799. And that's what your P&L on the day is telling you. It's 3,799. But look what happens to your margin. Because Apple has been going up, your risks to the position have increased. And so the broker is going to demand a higher margin. So now your margin requirement for this position has gone up from 11,000 to 16,000. Whereas in the case of a buyer, that margin, your buying power would not change, because he's already held $3,880 for your buy order, and that cannot change because your losses can't exceed that amount. But if you're a seller, you're going to be exposed to unlimited risk. Now, I don't want you to be alarmed by this unlimited risk position. There are ways to mitigate this, there are ways to control it, and we'll see that when we touch the next module, which is on spreads. We can easily control the risk on this side. But for a bare bones call seller, this is what his profile is. So, don't be alarmed by the seller's graph and this unlimited risk features. We can always control those risks. So that's what the 570 call looks like. Once the seller puts this position on and Apple starts to move higher, you'll see the white line is producing losses. And if it starts to go lower, then the white line is going to produce profits for the seller. So the seller's profile is exactly opposite of the buyer. Now let's look at our 625 call. So all I need to do is change this to my strike price of 625, and you'll immediately see the red line changes direction right here. So that's where our strike price is. It's at 625. And then beyond the break-even price, which will be the price of the strike price plus the premium. So in this out-of-the-money call, if you recall, $1.1 million option, the seller received only $10,000 as premium. So similarly, here we'll receive much less premium. We'll receive only $17.40 per share. So for 100 shares, we'll receive 1,740, and that is going to be our maximum profit if you're the seller of this option. However, again, if Apple continues to go up, then the seller is exposed to unlimited losses. But I want to zero in on this area here, okay? And this is really where a seller of options really stands to benefit from taking this kind of a position. If the seller sold the 625 call, if you look at it in simple English terms, the buyer is buying a right to buy this stock at the price of 625. So think of our $1.1 million example. The price of the land had to go from $1 million all the way up to 1.1, and then it had to go past the premium for the buyer to make money. So for a seller, he had all that room. If the price did not go up to $1.1 million and then past the amount of the premium, the seller was going to profit from the land deal. Similarly, the price of Apple has to go from 573 all the way up to 625 and then past an amount by the premium. So the seller has a lot of room for error. So between now and June 16th, if Apple does not cross this area here, 643, the seller is making a profit. So even if Apple goes up a little bit by $20 or $30, the seller can still make maximum profit on this deal. So we always considered the risk-reward profiles of both the buyer and the seller, and we felt that the risk reward was skewed towards the buyer. Now, this is a clear advantage for a seller. So you'll most likely, if you're a seller of options, you will sell out of the money options because you want probability on your side. And in this case, probability is definitely on your side when you sell an out of the money option. When you're selling an at the money option, you're taking a much bigger risk because an at the money option perhaps has a 50-50 chance of succeeding. Whereas this out of the money option will have a much higher chance of succeeding because there is so much room for the seller to be wrong. So this is all area where the seller can profit even if Apple goes up. So that's the advantage of being a seller of options, and most of the time if you are going to sell an option, you should think of selling an out of the money option, even though you'll receive less premium, but you're putting probability on your side, and that's actually more important than getting more premium. So when you're a seller of options, make sure you look at out of the money options very clearly, because if Apple expires anywhere between 570 and 625, you can still make full profit on the day of expiry. And of course, if Apple goes down, then there's no question the seller is going to make full profit. So that's as far as the out of the money option is concerned. Now let's look at our in the money option, which was at 520. So I changed my strike price at 520. So immediately you'll see that the red line changes direction at that strike, which is 520. And when you sell an 520 option, you're going to receive much more premium because this is in the money. So this is like our $800,000 option on the land. The seller of that option received $225,000 as premium. But you look at what happens here. So from a seller's perspective, his break even is going to be the 520 strike plus the $67 whatever, and that comes to about 587. That's exactly where the red line crosses the zero line. So that's the break even point. And look where Apple is today and look at the break even point. So what is the room for error? It's this little triangle right here. That is your room for error. So when you sell an out of the money option, when you sell an in the money option, your room for error is reduced by a lot. But you're getting a lot more premium, you're capturing a lot of the intrinsic value, but you have very little room for error. Apple can very easily go past this break-even point, which will be 587. So that's the thing about in the money options, and in the money options will move much faster than out of the money or at the money options. So your profits or your losses can accumulate very quickly. However, if you are right and Apple does go down, then you'll see your profits also accumulating. But in general, if you sell an in the money option, you're not putting probability on your side. As we saw when we sold the 625 call option, this red line was all the way here, and that's how you want your profit and loss profile to look like if you're a seller of options. So those are the three options that we considered. I hope it's very clear now what an in the money option is, what an out of the money option is, and what an at the money option is. There are pluses and minuses of all three types of options, and as we go along the courseware, I'll be explaining all of these. But this is the end of chapter 3. This is the end of the call options, and in the next course we'll be looking at put options, and we'll do a similar analysis. We'll have a presentation first, and then we'll look at real Apple options. If you have any questions, please send us an email, info@hackertrading.com. But otherwise, I'll see you in course 2, which is on put options. Thank you.